Welcome to Budgeting, Financial Management, and Reserves. Thank you for investing in your skills and knowledge as a community leader. I'm Neil Rasmussen with Associa. I began my career in community accounting and finance in 2004. Over many years, I've prepared thousands of monthly community financial reports. I've also enjoyed working with many board members who are new to their roles to help them better understand community accounting principles and practices. The experience I have gained will help me guide you through this course. So let's begin. A crucial step in understanding your association is achieving financial management proficiency. As a board member, you will spend a fair amount of time projecting and monitoring the financial condition of the organization. You do not need to have a financial background to be effective in these tasks. It's simply a matter of knowing what information is most important for you to review. Your association is organized as a mutual benefit, nonprofit corporation. In simple terms, this means that you are only allowed to collect the money you need to operate for the year, including scheduled reserve contributions and nothing more. This is an important concept to understand because it requires that you carefully consider the needs of your community and budget appropriately. Few associations have operating surplus funds available to cover an unbudgeted item. Some associations utilize a contingency fund of 3 to 5% of the operating budget to provide a small fund for the unanticipated items. A budget is central for determining how much money to collect and is the annual financial plan for the community. The budgeting process begins about 6 months in advance of the fiscal year with the initiation of the reserve study. A reserve study is a long-range planning tool that you leverage as a member of the board of directors. The purpose of the reserve study is to identify the common area components, things like roofs or asphalt or fencing and the like, that the association is required to maintain, estimate the repair and replacement costs, and then develop a 30-year plan for funding the work to be completed. The study is often prepared by an independent consultant with the knowledge and information required for this type of projection. A recommended best practice is to complete the reserve study with a site inspection every 3 years, while continuing to update the financial plan annually. In recent years, the reserve study has gained more importance as it is now reviewed by lending institutions to determine the financial health of the association during a sales transaction. This is a substantial part of the budget and should be completed first. When the reserve's budgeting is near completion, the board will also begin to develop the operating projections for the coming year and make sure that resources are available for all required projects. When both the reserve funding requirements and the budget for operations are complete, the regular assessments, or rather the amount charged annually to the members, can be determined. The regular assessments are often billed quarterly or monthly. If the budgeting process is the creation of the financial plan for the coming year, then the financial statements become the tool that the board uses to monitor results of that budget. By knowing what information is contained in each financial report and record, the members of the board can easily focus on what is most important. You should receive a complete financial package from your professional management company or bookkeeper on a monthly or quarterly basis. This package includes the financial reports such as the balance sheet and revenue and expense report, and also the supplemental schedules, things like collections or delinquency reports, bank reconciliations, accounts payable ledger, accounts receivable reports, and the general ledger. The first step in the package review process is to look at the balance sheet. The balance sheet is a snapshot of the association's financial condition. It includes 3 main parts. First, what you own or your assets. Assets generally include cash, accounts receivable, which is the money owed to you, and prepaid expenses. Second, what you owe or your liabilities. Liabilities include accrued payables, prepaid assessments, and under special circumstances, loans for reconstruction. Third, what's left over, which is your fund balances or your equity. As a mutual benefit nonprofit corporation, most of your fund balances or equity will be in the form of your reserve balances. You may also have a small amount of net income or net loss from the operating fund. The next document in the review process is the Revenue and Expense Report, which includes transactions which primarily fall under two categories: revenue and expenses. Revenue includes assessments, also known as dues, fines and interest, clubhouse rental fees, and any other sources of income collected by the association. Expenses include utilities, repairs and maintenance, and administrative costs and the contribution to reserves. The Financial Review Checklist is available to download. In addition to the balance sheet and revenue and expense report, the board should review other documents as referenced on the checklist. Finally, let's touch on the assessment collections process, as this can be a challenge for some associations. It's important because as nonprofit entities, there are not substantial resources to draw upon if assessments go unpaid. The board, in partnership with their management company or bookkeeper, should monitor collections carefully and make every effort to collect assessment revenue as quickly as possible. The first step in effective assessment collection is the adoption of an official collections policy. This document has two purposes. First, it provides step-by-step authorization for management, and secondly, provides clear communication to the homeowners about the process. This concludes our short lesson on budgeting, financial management, and reserves. Thank you for taking the time to invest in your role as a leader.